Are you building your real estate business on a strong foundation or just winging it? The right structure can protect your assets, save you thousands in taxes, and set you up for serious growth. But choose the wrong one, and you might be paying for it later, literally. Today, we're breaking down how to structure your real estate business based on your strategy so you can build with confidence and scale like a pro. Hi, and welcome to another edition of Brian Montross Talks Real Estate. If you're serious about building wealth through real estate, structure isn't optional, it's essential. Let's talk about why structure matters. Your business structure is like the foundation of a house. You wouldn't pour concrete without first considering the soil conditions, the environment, and the type of home you're building. A foundation that works in one location or for one design might not hold up somewhere else. And if it cracks, the whole house is at risk. Real estate works the same way. Your business structure needs to match your strategy, whether you're flipping, renting, wholesaling, or managing short-term rentals. What works for one investor could be a legal or tax disaster for another. When done right, structure becomes the foundation that supports growth. It can protect your personal assets, simplify your taxes, clarify roles when working with partners, build credibility with lenders and investors, and most importantly, set you up to scale with confidence. Don't build your real estate empire on sand. Start with the right foundation for you. For most long-term rental investors, the go-to is an LLC, and for good reason. It separates your business from personal finances, offers liability protection, and keeps your operation clean and professional. But remember, it's a business structure, not just a legal formality. To actually benefit from that protection, you have to treat it like a business. Keep separate bank accounts, document major decisions, follow the rules. Otherwise, a court can pierce the corporate veil and hold you personally liable. If you're operating as a sole proprietor LLC, the IRS doesn't actually recognize the LLC as a separate tax entity. Instead, it treats the income as pass-through, meaning it shows up on your personal tax return, just like if you didn't have a structure at all. The real benefit here isn't the tax treatment, it's the liability protection. An LLC helps separate your personal assets from your business, which is critical if something goes wrong with a property or a tenant. If you're building a larger portfolio, you might also consider separating properties into different LLCs to isolate that liability, so that a lawsuit tied to one property over here doesn't put your entire portfolio at risk over here. One way to do that, depending on where you invest, is through a series LLC, which also allows you to create multiple child entities under a single umbrella. Just keep in mind, series LLCs aren't recognized in every state, so talk to your attorney or CPA to see what works best for your situation. If you're flipping houses, wholesaling, or running any kind of active real estate business, your income is considered earned income, just like a paycheck. That means it's subject to self-employment tax, which can be a big bite out of your profits. This is where an S-Corp comes in. By setting up an LLC taxed as an S-Corp, you can pay yourself a reasonable salary and then take the rest of your profit as distributions, which aren't subject to self-employment tax. This can lead to significant tax savings, especially if you're doing multiple deals a year. Beyond taxes, flipping also comes with higher liability. Contractors, inspectors, timelines, and sometimes litigation. You want a structure that keeps this activity completely separate from your personal assets and your long-term rentals. Don't mix flips and holds in the same LLC. Doing so could lead the IRS to treat your rental properties as inventory, which opens the door to complicated tax consequences you don't want. Bottom line, keep it clean, keep it separate, and always treat it like a business. Short-term rentals live in a bit of a gray area. If you're self-managing, handling guest communication, cleanings, repairs, and turnovers, your income might be considered active, not passive. And that means it could be subject to self-employment tax, just like a flip. That's why structure really matters. An LLC is still your best bet for liability protection, especially when you've got guests coming and going, third-party vendors, and a higher chance of issues. And if you're making strong profits and running it like a business, electing S-Corp status might help reduce your tax burden, just like it does with flipping. And if you're planning to scale and self-manage, consider creating a separate management company. This gives you a cleaner way to handle income from cleaning fees, concierge services, or hosting, while keeping it separate from the entity that holds the real estate. It can also help reduce tax and streamline your accounting as you grow. The bottom line, STRs behave more like a hospitality business than a passive investment, and your structure should reflect that. Syndication is a group investment structure where multiple people pool their capital into a single real estate deal, typically a larger property like a multifamily building or a commercial asset. There are usually two sides to the structure, right? The general partner is the active manager. They're responsible for finding the deal, securing financing, managing the project, and communicating with investors. In exchange, they earn fees and a share of the profits. Now, the limited partners are the passive investors. They contribute capital, but don't have any day-to-day responsibilities. In return, they receive a preferred return and a percentage of the remaining profits, plus tax benefits like depreciation. Syndications are typically structured under Regulation D exemptions, either 506B or 506C. A 506B offering allows up to 35 non-accredited investors, but you must have a pre-existing relationship with them. A 506C offering allows general advertising, but only accredited investors can participate, and the general partner must verify that accreditation. Whether you're a general partner or a limited partner, you need to understand the legal structure, investor documents, and SEC compliance rules involved in the deal. You should always speak with a qualified attorney to ensure the deal is set up correctly and you know your rights and obligations. And for LPs, how you invest, whether from personal funds, an LLC, or even a retirement account, can have major tax implications. That's a conversation you absolutely want to have with your CPA or financial advisor before wiring any funds. If you want to invest in real estate but don't want the responsibilities of owning or managing property, real estate investment trusts, or REITs, might be the structure for you. REITs are companies that own or finance income-producing real estate. You can invest in them just like you would a stock, through your brokerage account or even a retirement account like a Roth IRA. They offer dividends, liquidity, and passive exposure to real estate without having to deal with tenants, toilets, or turnover. And because REITs are required to distribute at least 90% of their taxable income to shareholders, they can be a reliable source of income. That said, you don't get the same control or tax benefits like depreciation that come with direct ownership. And you're subject to market volatility, just like with other publicly traded stocks. REITs are a great structure for investors who want passive diversification or who aren't ready to buy a physical property, but still want real estate in their portfolio. So, how should you structure your real estate business? It depends on your strategy, your goals, and how active you plan to be. There's no one-size-fits-all answer, but there is a right structure for you. Whether you're buying rentals, flipping houses, investing in syndications, or scaling a short-term rental portfolio, your business structure should protect you, simplify your taxes, and support long-term growth. But one thing is universal. Don't mix everything into one entity. Different income types come with different tax rules, different liability risks, and different accounting needs. One lawsuit, one audit, or one bad deal could put everything at risk if your structure isn't solid. Structure's smart from the start. Separate your rentals, flips, STRs, and active income streams. Use LLCs for protection, S-corps for efficiency, and always talk with a qualified CPA and attorney before making a move. And if you're not sure where to start, or you just want someone in your corner, that's what I do. I help real estate investors like you grow with clarity, confidence, and a plan. Drop the word advisor in the comments below for a free consultation, and I'll help you figure out what structure makes the most sense for your strategy. If you found this video helpful, don't forget to like, comment, and subscribe for more tips and advice on all things real estate. Thank you for watching. And once again, I'll leave you with this verse. Be strong and courageous. Do not be afraid. Do not be discouraged, for the Lord your God will be with you wherever you go. This is Brian Montross, your real estate advisor.